very nice to see you again.
Nice to see you too. How are you doing?
Good, thank you.
I'm sorry John can't make it. He's traveling right now.
Not a problem at all, I understand.
She's right here, okay?
Yes, that is perfect. Would you like something to drink? Maybe some water or
yes,
coffee?
Please.
Water?
Okay.
Perfect, here you go.
Thank you.
You're welcome. So, I know that you guys have, been talking a lot about all the different goals that you have. And I'm actually really excited to have you in here so we can go over some of the financial planning that we want to institute for you guys. Everything from your balance sheet to insurance, investments, and estate planning and everything.
Sounds great.
All right, first I wanted to start asking, how your family's doing. How are the boys? How are Robert and Michael?
Everybody's doing really well. Everybody's healthy and things going great.
Good, that's awesome to hear. So I know that there have been some recent changes in your lives with the selling of the business a few weeks ago for $10 million, and I know that's gonna have an impact on you. So we'll get into that too when we get into everything. I just want to make sure that we're on the same page with what it is that you guys have as goals. So I know that I have it written down here for you, but just to reiterate everything. We are focusing on reducing any estate and gift tax liability and ensure that all your estate planning documents are in good order. We did review all of that. Also, we were looking through the insurance contracts and discussing possibly purchasing a long-term care policy, and we'll get into that also. And we discussed establishing a college funding plan for the 3 grandchildren and reducing personal income taxes. And then lastly was recommending a diversified portfolio for you, which is going to be a whole nother discussion. Okay. We did get all of your information, so thank you very much for giving us all that good numbers about your different accounts. It's very much appreciated. Okay, so let's dive into the balance sheet first. I did print that out for you so you can accompany me. We had a few different numbers in here. We did put an installment receivable on there of $8 million because the down payment will be received this year. So you should be only receiving the rest of it and any interest on that. So basically, from looking at your assets and your liabilities, it looks like you're in a very good financial position right now. Your net worth is upwards of $19 million. And also, we did a few ratio analysis. The first one is the current ratio, which it's a way of showing us how much of your assets right now that are liquid and current assets like cash and cash equivalents can cover your current liabilities if you had to pay them off, which right now you don't have a lot of current liabilities. You only have your credit card debt and the current portion of your vacation home mortgage. So right now your current ratio is 196, which is way above the ratio of 1, which is what we usually recommend for anybody. So this is a good thing, but it's also kind of a bad thing because it means that you have a lot of cash that can be used for like investments and in different parts of your balance sheet that you aren't really putting to use right now. You do have a very large savings account of $2.475 million, and I do know that you're planning to buy a new car, right?
Yes, I was thinking about it. Yep.
Yeah, so I know that you'd need $40,000, and that's not a problem at all. You can pull it right out of the savings account. And still, even pulling that from the savings account leaves a lot in there for you to be able to invest. We do always recommend that people keep money in their savings for in case of emergencies, so it's always good to keep 3 to 6 months in there just in case anything happens, heaven forbid, to you or John. So you could keep in there around like $600,000 and then invest the rest of it and still be absolutely fine. So right now you guys don't have a mortgage on the primary residence, which is awesome. I don't know if you can see that on this page right here. So right here under the current, there's nothing for primary residence, which is great. Even the mortgage that you do have on your vacation home is relatively small, and that's actually something that might be good for you to just pay off if there are no prepayment penalties. If you'd like, we can look at the mortgage information that you have, because you have so much liquidity right now. It's better to just pay it off.
Definitely.
Yeah, it's at 5%, so that's kind of high for mortgage interest rate right now. So it might be good to pay it off and then invest the rest of your money, and that would decrease your liabilities also. You also, so I know that one of the goals was creating these 529 plans for your 3 grandchildren. And so I'm just going to explain it to you a little bit. Every year, each one of you, both you and John, can gift $14,000 to each person without getting taxed on it.
Okay.
And for 529 plans, you can front load it 5 years. So that means that you guys can give $140,000 to each kid right now into their college plans. So the good thing about that is that you can fund it right now, and it'll grow until they get to college, which is going to be in many years, and it'll grow tax free. And if they use it for like qualified higher education expenses, then it won't be taxed at all. And also, it's like if one child doesn't use the whole fund, then you can transfer it to another one. So, maybe one of your grandchildren end up getting some kind of scholarship or some kind of help, then you can transfer the funds to another grandchild who might need it, which is a really good benefit of it. And then the other thing, there are a couple of bad things about it too. One of them is the fact that you can't make like any additional gifts in the next 5 years to them without incurring gift tax liability, because you've already used the exemption on this. Also, it'll, if none of the kids use the funds, like it'll just sit there, or else they have to pay a penalty if they take out money for anything other than for education costs. So that's something to think about. We still recommend it for you to do for your grandchildren, especially since you want to make sure that they're going to have enough money to make it through college.
And what would be the benefit of doing $140,000 per grandchild versus just $14,000 a year for the next 5 years? Would there be more growth potential doing the full $140,000 at one time?
Well, yes, because now you get the $140,000 growing for the next 5 years instead of just $14,000, and then that grows, but then you put in another $14,000 and then it compounds, but it's not growing from the 140 like baseline.
Okay.
The other thing about that actually you just reminded me of is that if either you or John die in the next 5 years, however much of that gift, like let's say you die in the next 2 years, the next 3 years of that gift go back into your estate because you didn't make it through the next 3 years. So they don't count as gifts that you've made.
Okay.
So that money goes back into your estate as a gift tax liability. So it's just something to keep in mind, but I mean, I know you're both in good health, so I'm not really worried about that at all. So that would be a really good thing to set up for the children. I was looking at your cash flows, which is the next statement there. And right now, I mean, you don't have excessive spending in any specific area. You do have a lot of premiums for different insurance policies, but they're all necessary, so that's fine. The one thing that I was going to tell you about would be that I noticed that you spent $35,000 on the charity in cash. So I'm not sure how you guys feel about charity, like if you want to do more or not. It's a really great way to pull some of the money out of your estate, and it's like if you want to create a family foundation, we can talk about that, or we can talk about creating a donor advised fund and then like gifting some of that, which will become like up to 50% of your AGI can be deducted for charitable contributions. So it's something to think about. It might be a place where you guys might be able to funnel some money, and especially if you start using up all of your exemptions for the gifts that you've been making to your kids and to your grandchildren. So that's something to keep in mind about. We can talk about that. You can talk to John about it first, and then we can discuss it later.
Yeah, I'll talk to John about it.
Okay, sounds good. So far, do you have any questions about your like financial statements and
Not right now.
cash
no.
flows? Okay, perfect. So, you mind if we move on to insurance?
Not at all.
Okay. So here, we looked at a scenario of the Winooski River flooding and causing $100,000 of damage to your vacation home, and how much of your homeowner's policy will cover that. So, we do know that you have a $460,000 policy on your vacation home, which is plenty for covering 80% of what the fair market value is now of it. The only thing is that most homeowners policies do not cover flood. You have to buy like a separate homeowners policy. I'm not sure if you know whether or not you guys have a flood rider on the policy, but that'll make a huge difference. Because if you do, then the whole loss would be covered.
Okay.
If you don't, then that's something we might need to think about if you live in the flood area, you know. You never know if something like that happens. It would be
Yeah,
big
I need to
damage.
look into the insurance coverage to make sure, because I'm not sure on that. But I'll
Okay.
let you know, and if it's not on there, then yeah, I definitely am interested in moving forward with flood insurance there.
Yeah, we can help you with that. We have great insurance agent contacts and everything, so you just let me know. The other thing that I did notice with your homeowner's policy is that the one for your primary residence doesn't cover 80% of your actual residence. So if something did happen, you would have to put a lot out of pocket. If there was $100,000 loss right now on your house, you'd have to put up $35,000 for it. So sometimes the market value goes up on homes, and our insurance policies don't keep up with it necessarily. So it would be good for you to like review that again with your insurance company and just raise up the coverage so that it's up to the $620,000 that it would need to be to cover at least 80% of what it's worth right now.
Okay.
And then moving on to your auto policy. So you do have kind of a high premium of $3,300 per year. It depends on what you want. Sometimes people like higher premiums and lower deductibles. Sometimes you can do a little bit higher deductible. It depends on what you want to do. But if you did want to lower your premiums per year, you could increase your deductible. It depends on what you feel more comfortable with. I also did notice that the property damage is only $15,000, which is really low. Usually it's around $100,000 and things like that. So if you want us to review that with your insurance agent and get it boosted up to around $100,000, we can do that also.
Okay.
And you do have an umbrella policy, which covers you above the home and the auto insurance, which is great. We always recommend people have umbrella policies. Right now it's only at $1 million. Because of your net worth, we recommend you increase it to like 4 or 5 million, just to keep it safe. If someone decides to sue you guys for something, then you at least have this covering above your other insurance. I do know that you guys got Medicare Part B insurance for your health. I know that it doesn't cover everything, and I did notice that on your cash flows you do have some out-of-pocket medical expenses, so it might be a good thing for us to look into maybe having a supplemental health insurance policy for you guys that isn't a lot per month but covers all the little holes that Part B does not cover.
Okay.
So if you would like us to send you an analysis on that, we can, with all the numbers and how much it would cost for you both to get it per month. And then for the life insurance policies, John's life insurance policies have an adequate face value, and he did transfer it out of his estate with the ILIT. It'll be fully in effect after 3 years if he dies prior to the 3 years, and it reverts back into his estate. For you, I did notice that yours was relatively low at $400,000. So we were kind of thinking of maybe having an ILIT purchase life insurance policy for you,
Okay.
because then you don't have to worry about that transfer in the 3-year period that you'd have to wait, and you would be able to have more coverage. You know, if you pass, then John would have more liquidity.
Okay.
So that's something we can talk about. I know that we also had this whole annuity. We had a little annuity analysis of the annuity policy that you have. The first payment, if you were to receive $350, the taxable amount of that would be $266.67. So that's something to just keep in mind, that a large portion of your first annuity payment would get taxed. So you did consider gifting it to Sarah, your granddaughter, and after we did some of the tax analysis and looked at the net taxable gift, it was $22,000 for you and $22,000 for John, with a gift tax of $4,240. So at the end of the day, it's up to you. I know that you guys would want to gift split it, so you would have to file a Form 709. It might be a good thing to give to Sarah. I know that her mother passed away, and you know, your son is, you know, kind of missing her, and this might be a little helpful extra money that might come in. And the last recommendation we made was for that long-term care policy. So it would be a comprehensive policy where you guys could share each other's policy benefits, and the benefits would be paid for 3 years or up to $360,000, whichever one comes first. The annual premium would be $4,750 for John, or $3,000 for you. Yours would be completely deducted if you guys did itemized deductions on your taxes.
Okay.
For John, there would still be $850 that wouldn't be deducted, but all in all, it would be a really good thing for you guys to consider taking, because if you can itemize it and get it deducted, it's a no-brainer on that one. So, any questions on any of the insurance?
No, just think that I need to talk to John about some of the things and see what he has to say. Sorry he's not here to go into
It's
it
okay, I
further,
completely understand.
Yeah.
And I'm hitting you with a lot of information, so,
Yeah.
and if you feel like you need to stop me at any moment, you can, absolutely no problem. So, now we get into the investments and your portfolio. So, if you can, as you can see from the first portfolio, the stock portfolio, your stock A is extremely low. It's giving you quite a loss there, and the beta is very high too. That's one area where we would recommend that you sell and just get out of that stock.
Okay.
Unless you guys have some kind of ties to it that I'm not sure. But
if it's losing money.
yeah, it's losing a lot of money right now. It's bringing the whole portfolio down. Everything else is up, which is great. We can use some of that capital loss against your capital gains, so we can use that for the next years. Also,
What if we entered into, we got out of stock A and purchased something different that was up? How would that affect the loss, the capital loss versus capital gain, like counter?
so you can always use capital losses against any capital gains. They always offset each other on your income tax returns. So,
Okay.
but if you're buying something, you're not gonna have any capital gain right now because you're just buying it. You know,
Okay.
you need to wait for it to go up or down in the market.
All right.
We would recommend you look into some stocks that are, you know, a little bit different from what you guys have now. Some different companies, maybe another index fund, or like some type of ETF, something like that just is a little different from what you guys have now. I do know that you have a bunch of different mutual funds, and there is the S&P 500 index in John's 401k account, which is great. And I know that you have the 2015 fund, which is also great. You guys have some diversification. It would just be good to go into maybe a growth stock that there's some potential for growth in the next few years.
Okay.
And another thing that you guys might want to consider just to diversify your portfolio a little bit more might be some alternative investments, maybe some hedge funds or private equity. And that's something that we can send you some due diligence on. We have some great hedge funds that we have invested in the past that have, provided some good returns for our clients. So if you guys get interested in possibly diving into the alternative investments, just let me know, because I can send you a lot of different companies, a lot of different funds that we've invested in.
Okay.
And all the numbers and everything that can be related to it. So I think that's basically it for the actual analysis of the portfolios. We do get into the investment policy statement a little bit. The main thing that I want to highlight in the investment policy statement is the fact that we do recognize that you guys do not want to invest in any tobacco stocks.
Mm-hmm.
We have put that everywhere. We want to make sure that we don't invest in anything that invests in tobacco. So we'll make sure that we always keep that as our priority when making investment decisions.
Okay.
The beta right now of your stock portfolio is 1.145. That is a pretty good number. The beta for the market is 1. That has to do with the risk that you have with your portfolio right now, which is, pretty good. The expected return for your portfolio is 10.77%. So we're hoping that your portfolio does at that level or better each year. Right now, the Sharpe ratio for your portfolio versus the market is a little low. This just means that your portfolio underperformed the market by, it was a very small percentage. It's only 0.08.
Okay.
So it's 8.29%, which isn't very high. But that's something to keep in mind. It might have to do with the fact that you have such a crazy stock that's been going down.
Yeah, I was just gonna say, is that all that stock A is doing?
That stock is creating quite a hassle in your portfolio.
Alright,
so
well, I would say I want to get out of it then.
okay, and so we can definitely work on doing that for you. So the next thing that I wanted to get with you and talk about income tax planning. We do want to concentrate on reducing your income tax liability. The investment interest income you currently have is taxed at the highest marginal rate. So we were thinking about maybe having you guys purchase some municipal bonds for your portfolio, which are tax efficient. And maybe also some ETFs, which has to do with, diversifying too, but those are all more tax efficient and might be able to help lower your income tax liability. Another thing that kind of ties into lowering your income tax liability would be the charitable contributions again that we were talking about earlier. So you can deduct up to 50% of your adjusted gross income, which is great. So if you want to dive more into that, we can definitely set up different things for you depending on what your main motive is. So I know that this first installment in the sale of the business and everything is going to make a huge impact on your financial statement this year and for many years to come. So for this year, we did look at how much of the down payment would be recognized as long-term capital gain.
Okay.
And it's a very sizable amount. It's $1,151,000. That would be taxed as long-term capital gain.
Okay.
Also, the payment that you would receive, the first installment payment, $91,774 of it would be taxed as long-term capital gain.
Okay.
Which is, it's better that it's taxed as long-term capital gain than regular income tax, because that's a lot higher, especially since you guys are in the highest tax bracket right now. Then we wanted to talk about another way of lowering your income taxes, which might be contributing to an IRA. And you can only do it for the next couple of years because you guys are already almost 70 years old.
Yep.
So, but that you can contribute up to the maximum, which is $6,500 each right now. and that would be a good way to lower your income taxes.
Okay.
The other thing that we ran a little scenario, assuming that John's great collectible, the 1918 inverted Jenny stamp, which he only got for $725,000. If he sold it in the next 10 years for around 1.5 million, and there was commission and everything on it, he would still have a federal tax liability. That's just something to think about.
Okay.
The tax liability would be $165,900, which is a lot of money if you think about it. But if he gets a great deal on selling that stamp, run the numbers by us. We'll do some of the math. We'll figure out what the liability would be. We'll figure out whether or not it's worth it. And one thing to just consider, no matter what income tax bracket you're in, the collectible will still be taxed at 28%. So whenever you get a great offer on it and you guys want to sell it, feel free to do so and run it by us, and we'll easily look and see whether or not it's a good value for what they're getting. The next tab will be retirement planning. I'm sorry, I forgot to ask, do you have any questions about the income taxes or anything we talked about there? Okay. I know that John probably can't even think about selling that stamp of his, but who knows? If there's a good deal, it's good to run the numbers and see how much you guys could get for it.
Yeah, I'll talk to him about it.
Yeah.
I'll see if I can convince him, but I don't know, we'll see.
Okay, we'll see. You just let me know. That's what I'm here for. So for the retirement planning, we assumed that John cashed his 401k with
Okay.
the fair market value of $1,054,540, and then deposited into an IRA account. And then after 3 years of growth, it would turn out to be $1,152,324. So this growth is only 3%, which is the guaranteed CD rate.
Okay.
We don't expect it to just be that low. We would invest it in different funds and try to get maximum return. But even if he only gets the 3%, it still grows at a decent amount. And the other thing is that we talked about growing your assets tax-free, and that would be by rolling it over into an IRA account. You can do both. You can do either like a Roth IRA or traditional IRA. It just depends on where you guys think you're going to be in the next few years when you start receiving the distributions, what tax rate you're going to be in, because one is taxed before and the other one is taxed after. One's taxed before you put in, and the other one's taxed once you receive the money out of it. So that's something that we need to look at, to decide. Or we can even do a Roth conversion, which is what we actually did as an analysis for the next section here, number 3. So ultimately, what we decided would be the best is for you to leave the assets alone in the IRA and not convert them into a Roth, because that provided the most value to your children, since they were at a lower tax rate than you are. When we did the Roth conversion, the fair market value of it today was a lot lower than you would get otherwise. So in that case, we would say, leave the assets alone for now. I know I just gave you a lot of information about that. Any questions on that?
Not right now.
Okay, perfect. So the last section that requires a lot of your attention, and this is gonna, we're gonna have to have a conversation with John about these things too, because it's majority of the assets that are going through probate right now are his. Your assets, other than your auto, are all just going straight to the beneficiaries. The only thing that isn't is your Chevy. And I know that you're going to be switching cars, so consider putting that into a joint name, or possibly having it, owned by a revocable trust or something. Like,
I was just gonna ask, can I purchase a car in the name of a trust?
you can put it into the trust assets. So right now his probate estate is relatively large with $13,707 going through probate, which is not very good because that means it's public record and you have to go through all the court and have all the attorney fees and everything. So it would be good to consider maybe doing some of the portfolios into joint names, the certificate deposit into joint name. Since he wants it all to go to you anyways, there's no point in not doing that. He does have the vacation home and his auto, also the boat and the stamp all on his individual name. Those are all things that you can put into the trust and discuss how he wants it to be distributed in the future, or he can own them jointly with you. The other thing is that right now, if John were to pass away, there would be a $200,661 tax liability on his estate. We want to make sure that we lower that as much as possible. So we want to think about pulling some of those assets out of the estates in all different ways. We can talk about different trusts, maybe some more. I know that you guys have set up some irrevocable trusts for the kids. Maybe some more trusts. Maybe donating more, different things like that. So those are things to consider.
What about a
Especially with
family
Johns.
LLC?
We could definitely do something like that, especially since you want to consider possibly giving more money to your grandkids down the line. That's a great possibility.
Okay.
We can discuss that too, and what assets we would put into it. We want to put some assets that that will be appreciating in value, so that if you have something right now that's worth $100,000, 5 years it'll be worth $200,000 or something like that. At least it's not growing in your estate; it's growing out of it, and you don't have to worry about that for the tax liability. So, for you, there's no tax liability if you were to pass away. You do have the 2 irrevocable trusts and the wills set in place, but you don't have any revocable trusts. You don't have any healthcare proxies or